Thank you for joining us for our fourth quarter investment outlook. As the third quarter drew to an end and as we enter the fourth quarter, volatility returned to the market in earnest. And our belief is that over the long term, the U.S. economy and the performance of risk assets are highly correlated. However, in the short term, they can move in different directions. And our belief is that's what we've been seeing in recent weeks. As the title suggests, we believe the U.S. economy is on a very good footing to continue to expand and to do so in a non-inflationary way. We'll stop short of saying that this is a Goldilocks sort of situation, but we think it's quite constructive and this economy can expand for a number of years yet without entering recession. As far as taking a look at the health of the economy, we really need to start with some measure of the employment backdrop. And here we're plotting the unemployment rate. This is what the Fed is using in terms of a guide for the timing of their actions. And you can see the unemployment rate has now fallen to 5.9%. That's almost right on top of what our estimate is for what we think the Fed is considering full employment at this juncture. Bottom line, the Fed, we think, is very near starting to raise rates here. The debate whether it will be mid next year or late next year is still an open question. But the fact is that based on the health of the U.S. economy, Fed action is going to be changing. Policy will be changing. One other measure of employment here, just yesterday we got the lowest unemployment claims number in 14 years. So the fact is the labor market is very healthy here in the economy, and a lot of other leading indicators look the same way. Now, as the headline suggests here, this is a real punchline for some questions we've been getting as we enter the fifth year of an economic expansion. The question is, how long can we go? And it's important to note that cycles die of overheating, of bubbles, if you will, not of old age. And here we're plotting GDP, but the same could be said if we plotted debt or PE multiples of the equity market or real estate valuations or any other bubbles that we've seen here that have brought cycles to an end. Here, if you look at GDP, you see back in the 60s and 70s and 80s, these boom-bust periods. But we think we're in a period now, much like the 90s, where it was an 8-year expansion. We're about 5 years into this cycle now without real excesses. The last GDP reading was 4.6, albeit that was pretty strong. We'll see what the third quarter looks like that we get pretty soon. But the point is, we think this is a not too hot, not too cold, fairly sustainable, long cycle sort of economy here in the U.S. With respect to other major macro themes out there, we're seeing commodity deflation. China's really at the root of this, as are other emerging economies as well. Here we're plotting in blue investment in China as a percent of their GDP. Almost half of their economy throughout the 2000s has been committed to infrastructure spend, if you will. China's been changing that policy, and if you overlay the price of oil, you can see there's a high correlation as China's a huge marginal consumer of a lot of commodities, and the rebalancing of the Chinese economy is something that's a very long-lived sort of theme. Now, there's other things impacting the drop in oil prices. Obviously, a strong dollar is one. The U.S. energy boom is another. But the fact is that this behavior of commodity prices trending down and providing a real help to the U.S. consumer, to be sure, with a stronger dollar and lower commodity prices, lower inflation here in the U.S. Augurs well for keeping, one, inflation tame, two, and benefiting the U.S. consumer and the wallet. In terms of inflation, here we're plotting core CPI and PCE, in other words, two measures of inflation, and what the Fed looks at is PCE. And the fact is that inflation is up off its lows, but is far from being a problem. The Fed has indicated that 2% is their threshold. The fact is there's a lot of leeway here for the Fed to be more accommodated if need be. But the fact is we think we've seen the bottom in inflation, but it's not off to the races by any stretch. In other words, another year, inflation is certainly not going to be a problem for the equity markets, or for that matter, the fixed income markets. However, we believe rates are going up, and to take a first stab at how much and how soon, here in blue, we're plotting the Fed funds futures. In other words, what the market thinks is going to happen with Fed funds over time. Now, over the past couple weeks, there's been a change in expectation here, given the slowdown in Europe and also in some of the emerging economies. And right now, expectations are for late next year and even perhaps into 2016 before the Fed really raises rates in a material way, at least in terms of Fed funds. However, if you take a look at what the Fed governors are saying in their surveys, the Fed governors have given plots here in the red square as to, based on time, where they think that the Fed funds rate will be. And after all, these are the people that are making the decision. You can see that there's a big disconnect between what the Fed governors are saying in terms of magnitude and timing of the rate hikes versus what the market's discounting. We'll see who's right, but the fact is the difference between these two can create some real volatility for the market depending on what happens. If the governors are closer to being right than what the market's discounting, obviously that's more volatility. Our point is that we think consensus expectations might not be accurately reflecting what will ultimately happen, and that rates will go a little higher and a little sooner than the market's discounting at this point in time. One other macro theme is the strength that we've seen in the dollar. The dollar's at a 5-year high against on a trade-weighted basis. And here in green, you see the U.S. dollar. We certainly don't make our living forecasting currencies. That's quite a challenge. But one thing about currency moves is they tend to be very, very long in their duration. They're not something that turns on a dime year to year. They're multi-year sort of trends. As you can see here, a strong dollar in the 90s, the other side of the coin in the 2000s, a flat period, and now the dollar is again gaining strength given the strength of our economy. If you overlay emerging market behavior relative to the dollar, you can see that emerging markets are one of those asset classes that are negatively correlated, meaning that here, if you look in the 90s when the U.S. dollar was strengthening, emerging economy equities were declining. We've seen that here recently. This is one reason why we've recently gone to an underweight in our commitment to emerging markets in the short term, reflective of our concerns about the dollar continuing to be strong. This is probably the most important, or at least timely, chart in the deck here, because this tries to correlate what happens with respect to interest rate moves and equity markets. And what the blue line here depicts is the last 5 tightening cycles by the Fed and how the S&P has performed over that period. In the middle here is the actual time that the Fed took their first hike, and then going this way is 6 months prior to the hike, and this is 6 months after. And you can see a couple of things. First and foremost, somewhere between 5 and 6 months before the first Fed action, the equity market has historically sold off, but the average has been about a 7% sell-off, which is something that we've really experienced here in recent weeks. And then the market slowly gains back, because, mind you, the U.S. economy in these cases is gathering momentum, and the Fed is raising rates to try and slow it. The point that we would also make is that just with the onset of hikes in the part of the Fed doesn't mean that the equity market is going to turn on a dime or that the U.S. is going to lapse into recession. Over the last 5 cycles, the U.S. on average entered a recession 29 months after the first Fed hike. More importantly, though, people are concerned about what the market does. And there's a couple of bullets here down at the bottom that indicate over the last 5 cycles, the market started to sell off, in other words, more than 10%. 7 months after the first hike, 15 months, 40 months, and in 2 cases, it didn't even sell off 10%. So what we're seeing now in terms of volatility is very typical as investors start to discount higher rates, but it's something that doesn't bring the cycle to an end by any stretch. In order to put this very unpleasant market correction of recent weeks into some context, here we've plotted the performance of the S&P since the market troughed in March of 2009, and this latest sell-off marks the 9th correction of at least 6% over that period of time. In other words, we think what we've seen and what we're in the midst of right now is just another correction in a bull market. Although they're not fun, it's something that is by no means, we believe, an end to this cycle by any stretch. This is very normal, though, as I say, unpleasant. If you look back at all these other instances, they've come out of some sort of growth scare, if you will, and currently that's the concern over Europe lapsing into recession. And our belief is that the U.S. economy, though a Europe in recession may take 0.5% off of the U.S. economic growth rate, that's still something that is not going to dramatically change the course of an economy that's growing around 4%. In summary, certainly, as we point out, the risk to the scenario, a Eurozone lapsing into recession with Germany at the head of that obviously is a concern. The fact that Germany is really weak for a change here may mean the ECB will actually take some action this time in terms of a sort of QE type of stimulus. Number 2, there's sort of the always present geopolitical event risk, whether it's be ISIS or Ukraine or now recently the Ebola impacting consumer confidence and behavior. But at the end of the day, we think that the U.S. economy is on increasingly firm footing, that interest rates reflecting that are going to slowly start trending higher, and that the dollar is going to remain strong. Volatility is probably here for a while, both in the debt and equity markets, but the U.S. remains our favorite equity market, and we're going to stay the course with our cyclical overweight and our allocation to equities as we wrap up the end of this year. We hope everybody has a terrific end to 2014 and a great holiday, and we look forward to catching up with you next year.